Welcome to the Tech Today podcast with your host, John Mayetta. High yield credit spreads need to widen, as we wrote last night. If you look at the ICE B of A high yield index and you look at that yield versus the 10-year, spreads need to widen. Take a look at spreads in the COVID period. Take a look at spreads during the financial crisis of that 08-2010 period. And I'm not saying we need to see spreads spike like they did during COVID and as they did during 09, but they need to widen. So when you think about high yield issuers, you've got the macro environment slowing. And yes, while the Fed said, we're likely done and that you're going to see rate cuts next year, a 25 basis point rate cut isn't going to do anything for high yield issuers. If we see the Fed cut Fed funds by 25 bips in March and by another 25 bips at the bottom of the year, that's not going to help high yield issuers who have to roll over debt at rates that are still elevated, right? Even if we find ourselves at a Fed funds of 5 or 4.75, that's still elevated versus where rates have been over the past decade plus. And when it comes to high yield, right, the name of the game is cash flows. And so not only do you have higher interest expense, but more importantly, you have a macro environment that's slowing. So you're going to have, slowing revenue growth, or maybe if you're a high yield company, revs are flat-ish. Now they're potentially down, and then you're going to have, margin pressure, right? Depending on the company, depending on the industry, that may make gross margin pressure in addition to operating margin pressure, and then you're going to have further earnings pressure, given interest expense below the line. And so cash flows are going to take a hit in 2024. The risk profile as it relates to the certainty of future cash flows goes up. So we need to see spreads widen in high yield land. That's all for now. I'll see you next time.